all indices are not created equal, and it's important for you to understand the differences when you're looking to make investment decisions that affect your long-term prosperity, buying, selling, rebalancing, whatever it is. That's because billions of dollars of retirement money are tied to market indexes, and there are differences in how each index is calculated. I'm bringing in financial advisor Doug Flynn. He's the co-founder of Flynn Zito Capital Management to explain it all for us. He joins us now from Garden City, New York. Actually, Doug, don't explain it all. Just explain a little bit. Let's just explain why how the Dow, which is 30 stocks, is different from the S&P 500, because these are the two that are most often quoted.
That's true, and the biggest difference is that the Dow is set up with those 30 stocks, with the stock that has the highest price per share getting the greatest weighting. It has nothing to do with the size of the company, just the biggest price per share downward. And the S&P 500 is in order of the largest companies in America. The biggest ones get the higher percentage, and down you go. So that's a key differential between the two in terms of how they're weighted within the index.
Let me just give you an example of how this works in practical terms. We've got here the Dow versus the S&P 500. This is the percentage gain since the beginning of the year and since the beginning of 2013. Now, if you go back to the beginning of 2013, if you had $100 in the Dow, you've gained 30%, 29.65%. If you're in the S&P 500, 32.39%. So over that period of time, they've not been that different. But just look at since the beginning of this year, Doug, the Dow has returned you 4.7%, while the S&P 500, 9.5%. Tell me why.
Yeah. Well, the biggest difference is if you take a look at the biggest holdings in the Dow and the top holdings in there, the biggest one is actually Visa, and Visa has a negative return so far year to date. So when 1 out of every 12 cents that you invest in the Dow is in Visa and it's negative, then that's going to weigh down and hold you back. And conversely, if you look at the S&P 500, the 3 biggest holdings in there, which are Apple, Exxon, and Microsoft, they have the same 8% weighting, but 2 of the 3 of those are up 20 to 30% year to date. And so what you've seen is you've seen a momentum move into technology and growth year to date, and it's the underlying stocks that make up these indexes that really tell you what kind of return you're going to get. And that's what I think escapes people, is they think of the market, they think of the Dow and the S&P. They don't think that they're actually individual securities that are in here, and what you invest in really does dictate how well you're going to do. And year to date, it's swung towards technology and growth.
Is there a takeaway here, though? Because if somebody says, hey, I'm an investor, I'm a passive investor, which is what most people are, which means maybe they check their investment a couple times a year, 3 times a year, 4 times a year, and I like to stay diversified, so I'm in the Dow. Versus I'm that same investor and I'm in the S&P 500. Is one, I mean, historically they have moved largely in lockstep. This year is an unusual example.
That's a great point, and that's true. If you look at it over 10 years or longer, they're a pretty good indicator on how the markets are performing. They're pretty similar. But you do have pockets of time, and you have to ask yourself this question. If I believe, technology as an example, that's about 18% of the S&P. It's only about 11% of the Dow. The Dow is much more value stock oriented, dividend oriented, and some would say a little bit more, a little less volatile than the S&P. Right now, with the makeup that it is, you have to ask yourself, where do I think the markets are going? Do I like Apple and Google and those types of companies that are very large and growth oriented? If I do right now, then that would lean me towards the S&P. But if you look at the weighting in terms of price to earnings ratio, which you could use as an indicator on how things are valued, right. The S&P 500 is right at around 17, which is historically the number, but the Dow PE is only about 15. So what it tells you is there has been a move towards growth, towards technology. It's favored the S&P. We just don't know if that's going to continue. And if it does turn around, you might find a little bit more downside protection on the Dow right now.
Because the Dow is relative to the S&P 500 a little bit undervalued.
A a little bit undervalued. It has a little bit more value stocks. The Dow definitely leans towards the value type of stocks, which are dividend payers. Only 23% of the Dow is in the growth category, where a full 1/3 of the S&P is in the growth category. So as growth goes, that's going to lean you more towards how the S&P does. But if that turns around, or it runs its course and there's a correction and growth and tech stocks get hit a little bit harder, you're going to find the S&P go down a little bit more than the Dow, which has a little bit more of the value types of stocks in there.
If I am an autopilot kind of guy, and I just want to dump my money into one or the other, and I know that's a little bit unsophisticated. If you're going to be autopilot, you should at least have a few more things in that pie. But if it's either the Dow or the S&P 500, does one make more sense than the other?
I think for most people, the S&P 500 as the barometer that everybody compares themselves to is a great way to be invested. But I would put to you that if you're a little bit more conservative in nature, as the markets get higher and higher, and you find the S&P 500 pulling away in terms of valuation and maybe getting overvalued, you would find a little bit less of that in the Dow. So you might lean as a more conservative investor into those stocks in the Dow. And they also appeal to those who might have a little bit more of a dividend tilt, people that's more important to. So one doesn't necessarily isn't better than the other. I think the S&P is more in favor right now with how the underlying stocks are. But once that runs its course, you find a little bit more value in the Dow types of stocks. And also as a more conservative investor, I think that might appeal to them more. So that doesn't make it right or wrong. It's just what kind of investor are you? What's your risk tolerance?
Right. Doug, good to see you as always. Thank you so much for joining us. Doug Flynn is the co-founder of Flynn Zito Capital Management.